Welcome to the Midweek Market Update, where I do a technical analysis and give you my thoughts on SPY the Qs and IWM. This week I've also got 5 trade ideas to share with you towards the end of the video, so definitely stay tuned for that. First things first, let's start off the analysis with the sectors as we always do. Who was leading, who was losing, and where was the weight? The builders led the pack today, up 1.01%, whereas the XLV for the healthcare sector was down at the bottom of the barrel, down 0.29%. As we know, builders don't make up a huge weighting in the S&P 500, so no big deal there. But the XLV actually is the third heaviest weighted sector that we monitor, at least, so kind of concerning to see it at the bottom of the list. I will discuss my thoughts there in just a moment here. In terms of heavier weighted sectors, certainly the XLK, the heaviest of them all, up at the top of the list here, up 0.47%. The XLF a little bit lower, but still green on the day, up 0.07%, second heaviest weighted sector. We did mention the XLV being the third. Obviously, we discussed down 0.29, but I also want to point out that the XLY for consumer discretionary, it is in the top 5, so it is nice to see that kind of at the top of the list there with the XLK as we're getting a bit of a bullish consolidation on today's S&P bar. So with that being said, let's dive into the charts here and just make sure that risk isn't mounting in one place versus another. I would say that the XLK is a pretty tough read right now. The question on a lot of people's mind, in terms of direction at least, is this a dead cat bounce from this overall downdraft here? Or are we going to continue higher? Is this the start essentially of a brand new move here? And the reason it's so difficult to say the direction based on how the chart is unfolding here is because, yeah, we did make a new higher high, but we did make a new lower low, right? You could start to look at this as a broadening top pattern, something that would look roughly like that. And if you were to just draw the midpoint, it's kind of right where we're sitting. As we know, whenever you're in the midpoint of a range, it's extremely difficult. It's basically a coin flip on whether or not it's going to be higher or lower to those better inflection points where your risk reward really lies. So I would take it day by day here in the XLK, and because we're not entirely confident in terms of direction, I would continue to say that this may pose a threat to the S&P 500. We just don't entirely know yet whether or not it will be a lower high. The bearish scenario that we really want to try hard to avoid would be a lower high at the 50 SMA, a reattempt to that all-important 164. Once again, that would be 1, 2, 3, 4, now 5 interactions, especially off of a lower high. That's probably setting up for a breakdown in my estimation, which will of course be a drag on your S&P 500. So that's the scenario that we want to avoid, but do be aware of it if it starts to unfold. Obviously, if this just chugs higher, it's all about the resistance trend line from that original bull flag we discussed right around in there. Let's continue on in terms of sectors, talking about the XLF for financials. Obviously, the rates sort of taking off, hugely benefiting this sector as a whole. I would start to say, though, that it's not too far too fast, and the main reason would be that we had certainly a gap up and then a run, right? But we also had a day down, a day of consolidation. Next day was the breakout, another day of consolidation, another day of consolidation. So it's not just like we've had like a string of green candles, one after another, just running away here. There's been some push and pull, some give and take, which is a good thing to really confirm this movement. Of course, it being backed by rates is a good thing as well. So, of course, we did set a new higher high, a new all-time high. We can now afford a higher low pullback. In an ideal world, rainbows and butterflies, we would hold on to the prior 3-day highs and the next 3-day lows, right? Beautiful thing from a technical perspective to see prior resistance now turning into support. That number is at $40.75. If that gives, ultimately the line in the sand in the XLF is way down here, the top end of this prior range. Remember, it felt like forever it took to resolve this. If we were to pull back into it, we would need to support there. That number is 39.25 roughly, and that would give us, again, back here's your major low. This is a higher set of lows. We'll put HL, and if we support at the top end, then again, we get another set of higher lows, thus sort of preserving the longer-term daily uptrend in financials. Let's take a quick look at our TNX while we're talking about financial things. This is, of course, the 10-year rates. We're going to zoom in and clearly just cooling off. And that's a good thing, I think, for the marketplace as of right now. Obviously, if this were to continue to scream and trend higher, it's really going to take a toll on that XLK, which we really know is the all-important sector for the S&P 500. So it's a good thing to see these rates cooling off. I think stabilization is what we want to see, not an aggressive trend higher, but also not an aggressive trend lower, right? Remember that if this continues to fall apart, if it does fall apart all the way back down towards 1.5, that could do a number on your XLF, so down here. Now, granted, it's not going to be as aggressive as or not as significant amount of damage as if this were to trend higher. What I'm getting at is that the XLF being the secondary sector sector in the S&P 500, if this were to fall apart and break the financials, that's not as big of a deal as compared to this taking off to the upside and breaking the tech sector, right? That would obviously be a much bigger ordeal for the S&P 500, probably bringing it a little bit lower. So the main thing, I guess, to take away from the TNX would be you really want to avoid rates taking off in an aggressive way to the upside. Stabilization is a good thing. It's okay. And a pullback it's all right. It's not the best thing because we know it will hurt financials, but overall it should, see an uptick in tech benefiting that sector as a whole. So hopefully that wasn't too confusing. I know I sort of stumbled over some of those wordings in there, but you get the gist, right? Ideally, we see a sideways TNX. I should also point out that we did get CPI today, and that of course came in at only, quote unquote, that's a little sarcasm there, 7%, which the market sort of expected. It kind of priced in, of course. They were expecting that, or it would have been worse, obviously, if it was higher than 7%, but we know inflation's high. It's not new news to anyone. The market sort of, could handle seeing a number like that come out. Let's get off of the TNX now and some of these more nuanced things and talk about the XLV for the healthcare sector, third heaviest weight. I will continue to maintain that I really think the show is between the XLF and the XLK. It's not so much about the healthcare sector right now. So, if you had to pick two to keep an eye on, those are obviously the big two. XLV, sure, it is technically coming in for a higher low, something that preserves this trend right here. So I would say it's fine from that perspective. This pullback is a little bit more aggressive than what we would have liked to see. But again, nonetheless, still a higher low. We are sort of bouncing and respecting at that 50 SMA. So not a huge amount of risk right now in the XLV. The main thing I would not want to see is a lower high, something like this. That sets up, what did I just draw, right? Inverted head and shoulders, something like this could pan out to be shoulder 2. Break of this neckline should probably break down the daily trend and easily take us in for an equal low closer to 129. So that's a scenario you do not want to see in the XLV, but if it starts to unfold, at least you're prepared for it. Let's take a quick look at volatility now. So the VIX. And zooming in on this chart, again, Monday was a very, very interesting day out there in the marketplace. The VIX certainly taking out that 2050 volatility trigger number, but closing back down underneath. And what you'll notice is that we do have lower highs. So the amount of fear out there in the marketplace, probably based on, the proposed interest rate hikes, the inflation that came out today, it's not as significant as it was back here when the market was first trying to digest some of that information. So I think people are sort of assimilating to that, new knowledge. And again, the market's just preparing for that. So it's not as big of a deal. So VIX not really telling us a whole lot, kind of smack in the middle of our acceptable range in here. We're not really at a point where we're going to get the complacency effect above 15. And we're also not really at a point where we need to keep our stops and targets looser, sitting right at 2050. So volatility, quite neutral, not really telling us a whole lot. I guess if we read into it in the opposite sense, it's basically telling us, hey, don't panic. The market's kind of all set in terms of volatility and fear right now. Let's go back on over to the S&P 500 daily time frame chart and just talk about some of the nuance of this technical chart right here. The main thing I want to break down is what happened on Monday's session. Very, very interesting open there. It certainly felt like hot and heavy selling, and we'll see in a minute here that the internals would support that move lower and in a significant way, but obviously big lower wick, and we've actually closed back inside of the 2-day balance from the prior Thursday and Friday session. So that to me right off the bat was kind of confusing, to be quite honest with you. It definitely caught me off guard. However, we've got to go with the chart is telling us, and you can certainly see that we do have now a higher low. We're respecting the support trend line down here. We've closed inside of the range. Obviously, that gave us a little bit of a look below and fail type scenario. Target was the top end. We fulfilled that and some with a bullish consolidation bar on today's session. The reason I say it's bullish is because we did fill the gap underneath us, and we closed back higher outside of the Tuesday range. You'll also notice that we're trading back above this level right here, that all-important breakout number 470.40. So to me, the market probably wants to try to make a move from this area of high value, high volume to the next area of high value, high volume, which would be here, closer to the all-time highs. I think we get there sooner than most people anticipate, given how aggressive this sell-side move was. I think people just sort of automatically geared up for the bear camp, and they're not really prepared for the market trading at these levels again. Don't get me wrong. The XLK still could potentially be a dead cat bounce, give us a lower high, set up the re-breakdown. It's definitely on the table, but based on everything that's in front of us here, I don't know. I mean, to me, I think we could get here much sooner than we could potentially get all the way back down to here at 450. Those are my thoughts. Again, bullish consolidation resting day on today's session. 50 SMA has been recaptured to the upside. It just looks more bullish than bearish. Like we're just continuing that weekly uptrend that we know has been in effect for so long, right? This dominant support trend line strikes yet again. Let's go on over to our internals here. If you're not familiar with this screen, go ahead and get familiar. Top right-hand corner is a video on what this all is, how you can set it up, and how it'll help you make better intraday trading decisions. The first thing I would point out is, again, the aggressive sell-side nature of Monday. Look at how we are immediately falling off in our breath. We were easily on track to get to minus 300 million on the day, but it leveled out into the afternoon as the rally happened. Internals support the move on Tuesday, and again, just bullish digestion on today's session. Same thing holds true on all of our internals here, except for one little surprise, right? If you look at what the cumulative build did on the tick, it really didn't get overly aggressive to the downside on that Monday morning session. So to me, that's the one indication that sort of said, hey, you know, sure, we're just kind of sitting here in negative zone, but as the afternoon unfolded and as we got out of that negative zone, it was sort of a reminder to say, you know what? What's actually happening out there across the market right now is accepting this rally. Like stocks on an individual basis on the New York Stock Exchange are ticking higher more than they're ticking lower. So to me, that supported this move higher here. Don't get me wrong, the internals before that were screaming bearish. So the fact that we were able to rebound out of that, again, it's just a little bit of a sign of strength there at the low end of the support trend channel. The fact that even on terrible internals, we got no follow through to the downside. So again, think about it in the reverse scenario. What is that telling you about the sellers here? They, you know, although they certainly seem strong, they, in all actuality, were not as strong as we may have thought. So a little bit of a misread on my part. Certainly in the Discord, I was sort of looking at this morning saying, wow, I think we're kind of in for it here all the way to the support trend line. Didn't unfold that way, okay? So that's how I'm thinking about the internals here. Again, just a balancing day on today's session. Extremely neutral and muted cumulative read in the tick. Just going sideways here, not a whole lot to read into there. Let's continue on to our market profile. Again, I've got a video for you if you're not familiar with this software. Top right-hand corner, we'll describe what this is and some of the terms I'm about to use. On today's session, perfect balance day, right? That's basically a normal curve. The point of control is smack in the middle. The value area is smack in the middle as well. And once again, we filled the gap from the prior day. We can look at this like this, and this was sort of the value that I was sort of pointing out on the SPY daily and how the chart should move, right? This was a chop area in here. You can see that we have overlapping sessions. How many? One, that's an overnight, of course, but 2, 3, 4, 5-ish, 6-ish, 7-ish. We're coming out of this area of balance and value. I think the move should be closer to here, around 47.80. We've talked about the importance of that number in the past. It's basically the high volume node from all of that prior consolidation happening way up here. So the market should move through this area of low liquidity with relative ease. That's kind of what we saw today. Now it's just a question of, do we make it to that point of control, the high volume node at and around that 47.80, or do we resist off the bottom end of the range, which as of right now, we haven't made it quite all the way there. Those are just some of the things I'm thinking about in terms of how the market should be, quote unquote, should be moving from high value to high value through areas of very thin activity like what we saw in this area of the profile. So just a balancing day in terms of direction, not really telling us a whole lot. I did want to illustrate and zoom out there so you could see the balance to balance type move, which I've been referring to. Let's go back on over to the platform and round out our broad market here. We'll come on over to the QQQ. And again, this is going to be very similar to that XLK, which we looked at. However, notice that we don't have the higher high here. We actually have the prior all-time high. So a bit more of a downtrend in effect. We can do something like this with the Fibonacci's coming in from the high all the way down to the low. And once again, we're kind of sitting right at the midpoint of the overall downdraft. Even though we don't have technically that broadening top, we're just smack in the middle of the move. I would say we're above some of this prior resistance right around in here, the 2 days of consolidation from Thursday and Friday last week. So just like the S&P 500, a little bit more bullish from that perspective, but certainly not anywhere near, you know, coming back to those highs as of right now. I do think that we need to pay attention to this 393.10 area coming from this prior consolidation. Also the breakdown point from here where that sort of quote unquote scene of the crime unfolded. So that's the first target to the upside. It's also the daily 50 SMA as of right now. In a stronger market, we would have recaptured that. So again, in the S&P, we did recapture the 50. So tech is looking a little bit weaker just based on a relative strength basis. So keep that in mind. Again, 393 is really the major area to be watching out for. Anything after that, sure, start to look for this consolidation area and your resistance trend line closer to 400 in the QQQ. If this is going to be a lower high here, again, you got to watch out underneath 378.50. We know that that's the big area to be holding here. If it goes, kiss this one goodbye, probably coming down to 369. Again, I'm not forecasting that. We know direction's kind of a 50-50 shot in terms of where we're sitting right now. Just scenarios and numbers to be thinking about. Next up, and lastly for the broad market, we have the IWM, which of course is the Russell 2000 and small caps. Relative weakness here, not nearly making as significant of a rebound. Definitely closing weak on the day as compared to more of a consolidation doji. We're also underneath, once again, those 2-day balance highs, nowhere near the 50 or 200 SMAs here. The only saving grace that this has going for it right now is that this could potentially be a higher low from this perspective. We really need to make, though, an equal high to up here, which we've discussed in the past could be a bit of an inverted head and shoulders. It's not the prettiest pattern, I'll definitely give you that, but if we were to come into 226.69, I would say that would be a constructive thing for the IWM to do. We would watch for something like this, higher low pullback. If that happens, that starts to build this as more of an ascending triangle as opposed to that sort of inverted head and shoulders, which we just discussed. In terms of an overall market indicator, it's just starting to say, you know what, still neutral here. It's not overly aggressive. Don't get all rallied up based on this little sort of bounce that we've seen. The IWM's kind of still hanging out in the neutral territory. As we know, underneath 215, it does start to become a little bit more bearish. Big red flags go off underneath 208 in your IWM. Let's get into these trade ideas now. I'm sure what you all want to hear about. So CCL is going to be the first one. And what we've got here, if this would zoom in, there we go, is a little bit of a pressure cooker top, right? Look at all of these touches right at and around 22.25. We closed above it on today's session, so I would be watching out for a bit of a rally here to that next major area of resistance. Think about all of the pressure that's been building in these two areas of consolidation. If it's all released at once, that sort of triggers that breakout point, right? The one thing that you would want to see hold here is not this support trend line anymore. However, it's this one, a little bit more steep, but certainly what you would want to use as a trailing stop loss. If we break down underneath that, it kind of invalidates the trade. The other reason I like the setup for today is because we did print a bit of a hammer candle, right? We tested back down into the range, but closed back above. So I am looking for some follow through here inside of CCL. Do keep in mind that this will be sensitive to the sort of sickness news out there. Just something to have on your radar, right? I wanted to make sure you know that. Next up, we have F for Big Bad Ford, and it's not really big and bad because this is going to be something that moves like molasses. However, there's an opportunity here, right? So it is worth noting, big bull flag forming on the daily right after we've broken out of this range. Obviously, big relative strength in this name over the past couple of weeks and even month. So watching for this to unfold higher. Again, a nice hammer candle on today's session, respecting some of that pullback low that we've seen in the past at the midpoint of the range as well at 24 even. So watching for a break up and over 25 for this to get back up into it's not technically blue sky territories, but it's rather uncharted territories. We have not been trading up here recently anytime within the past, I believe it was before the sickness as well. Let's just grab some more time. I don't want to misinform you. So we'll go with 5 years. Yeah, look at that. Actually, maybe it is a new all-time high instead of Ford. I just want to make sure and not mess this up. So yep, we're going to grab as much time as we can here. Time interval, that's what we want, max available. Yeah, so not a new all-time high, I was right about that, but again, we have not traded here since 01, so again, I do feel like this is relatively uncharted territories based on the weekly or monthly now. The next major area that I can see here would be closer to 32. I'm not saying it gets there all in one go, but it is a level to potentially have as and if the breakout continues here from the daily time frame chart. So I know we spent a little bit of time searching for those levels and just confirming the info, but it's always good to confirm that stuff and not just fly blind. Next up, we're going to have Home Depot, so HD. This is actually a bearish trade idea off of big double top. If you look at this, touch 1, sort of touch 2, where does that put the neckline? Right here. Let's go ahead and throw that on with a regular price level. There we go. So anything underneath 380 essentially is going to start to break this down inside of Home Depot. I wouldn't overstay your welcome. My first target would kind of be here. And I know that's a fairly aggressive target lower. It's the low end of this prior bull flag. Home Depot is generally speaking a relatively healthy stock, and you don't want to fight the dominant uptrend too much. But if it does start to break down underneath that, there's at least a day trade available, probably for a scalp as well, to the top of the prior flag highs here. It's going to close the gap also to about 375.36. The reason this is a bearish trade name, medium for us is because we have two inverted hammers back to back. We close the gap, we resist off the gap, we're underneath the 50 SMA. Again, a breakdown of this larger double top neckline could be interesting for some downside inside of Home Depot. Obviously not interested if 380 never breaks in the first place. Next up, we're going to look at Las Vegas Sands. LVS is the name, and we're zooming in here, very similar to CCL with another pressure cooker top. You can see all of these touches here to about 39.50, 39.40s. If it breaks, your next target's going to be up here, closer to 41.50s, okay? So something that looks like this. Again, you get a support trend line, a bit of an ascending triangle, if you'd prefer to call it that. A breakout takes you here, and you're going to be skeptical because, once again, this will be impacted by sickness news, being that it's a large casino-type hotel, right? So that's what we're thinking about here, but the level does look good. The technical pattern does look good. Don't overstay your welcome once we get to 41.50s, just based on the strength of the daily downtrends. For now, it's probably just a scalp. Reevaluate the chart when we get there. Not interested if the level never breaks in the first place. And then the last trade idea I've got for you is going to be on QCOM for Qualcomm. And this one has just been, I mean, to me, big relative strength. It's almost as strong as Apple. Certainly the trend isn't as clean over the past couple of months, but it's been hanging high and tight as opposed to completely falling apart like some of our other tech companies. If you were to look at like Facebook, for example, not nearly as beautiful area of consolidation. Now, yes, we did print an inverted hammer on today's session, but because we're at the top end of the range, and we always know that there's opportunity at the top end of the range, I wanted to bring it up. So of course, the inverted hammer would suggest some sort of pullback could be likely. In the case where we get a higher low and then reattempt though, that's where I'm starting to eyeball this for breakouts up and over roughly 188, 190 if you want to be more conservative. And I do imagine that 200 does start to act as a magnet here inside of Qualcomm. So that's the bullish setup. If it starts taking out the 50% mark of the range and actually moves underneath, we'll just throw that on with a level. It's going to be right here at 182 roughly. Then sure, I would be patient. I would wait for a move to the bottom end of the range, see if we start printing hammer candles down here, and if there's an opportunity to rotate once again to the top end off of the bottom, right? We don't want to play around too much in the middle. Opportunities always here or at the top of the range up here. That's ultimately going to wrap up the video today. If you enjoyed it or learned anything new, let me know in the comments section or by giving the video a thumbs up. Don't forget our main channel is linked in the description. And all of that being said, I wish you a green trading week.